Conceptual framework for financial reporting.
Introduction of consumption framework is reserved conceptual framework come out on 1 January 2018 by IASB, effective immediately for the IASB and IFRS. Accounting professionals develop a set of principles of guidelines called consumption framework, not an FRS. Purpose of consumption framework is assist MASB in develop future and prepare of financial statement editor informing and opinion user for financial statement provide who are interested in work for MASB. The objective is useful to making decision, estimate the judgment and models, help the user to get full information of financial reporting. Fundamental qualitative characteristics have two types: relevance and faithful representations. Relevance: predictive values used as an input to proceed employed by users, making their own predictors. Confirmatory values provide feedback about previous evaluations. Materialities: omitting and misstating influence decisions. No specifics. Uniform qualitative. Faithful representations: complete, understand the phenomena, including descriptions and explanations. Descriptions: nature of asset, numerical descriptions. Nature without bias in selections or presentations. Fair, no weakness. Free of errors, no errors or omissions. Descriptions of phenomena. Produce reports informations. Enhancing qualitative characteristics. Information must be relevant and faithfully represented. Help make good decisions. Effective and efficiency process. Step 1. Identify economic phenomena. Step 2. Identify the type of information about phenomenon. Step 3. Determine whether information is available can be faithfully represented. Comparability: identify and understand similarity and differences among items. Verifiability: help assure user the economic phenomenon timelines to decision maker in the time to be capable of influencing their decision. Understandability: classifying, characterizing, presenting.
Underlying assumption going concern prepare on assumption. Second, company will going concern or continue operation in the future or not. The third, entity has neither the intention nor the need to liquidation or curtail materially the sale of operation.
Basic element: have asset, liability, equity, performance, income, expenses, capital. Asset: economic resource controlled by entity. Resources is right that have potential to product. Person litigations of a entity and obligations entity have particular ability to avoid. Equity: resources interest in the asset and entity affect after an entity after reducing all liability. Performance: profit is frequently used as a measure of performance. The basic from measurements elements direct related to income and expenses. Income: cost of the ordinary activities of an entity. Expenses: cost of the ordinary valuations of assets such as cash, inventory, property, plants, and equipment. Capital regulation or remeasurement of the asset and liability decrease in entity.
Two categories in measurement basis. First, historical of measurement basis. In our historical measurement basis, have historical price of the transaction or event. The second asset would be the cost insurance in inquiry. The liability be the value of consideration take on the liability. Second measurement basis is current value measurement basis. Provide momentary information. Using information updates to reflect condition at measurement. The third measurement fair value in use, fulfillment value, and current cost.